Very good morning, viewers, and welcome back. And this time I'm going to discuss a very hot cake topic, that is mutual funds. Now, first I'm going to give some introductions, and then I'll be discussing certain terminologies, and definitely I'll be discussing the various advantages and disadvantages, etc. Now, a mutual fund is a common pool of money into which investors place their contributions that are to be invested in accordance with the stated objective. A mutual fund is the most suitable investment for the cautious investors as it offers an opportunity to invest in a diversified, professionally managed basket of securities at a relatively low cost. Now, mutual fund is a type of passive investment. If investors directly invest in market, is known as active investment. Now, right now, I am going to discuss the various terminologies which are actually being used in the context of mutual funds. Now, first, I am going to discuss about net asset value per unit. In short, it is called NAV. As per SEBI regulation, every mutual fund company should calculate its NAV on a daily basis, excepting holidays, where NAV is equal to net assets of the scheme, whole net assets of the scheme, entire thing divided by number of units outstanding. Now, what are called net assets? Net assets, that is total assets minus total external liabilities, is equal to market value of investments plus receivables plus accrued income plus other assets minus accrued expenses plus payables plus other liabilities. NAV signifies the realizable value that the investor will get for each unit that one is holding if the scheme is liquidated on that date. NAV is calculated for each scheme and not for whole company. While using NAV, we should always give preference to market value. If market value is not given, then we are required to use the book value. Now, in this connection, right now I am going to mention about how the return is calculated. Now, investors derive three types of return, namely number one, cash dividend, number two, capital gain disbursement, and number three, change in the fund's NAV per unit, that is called unrealized capital gain, that is calculated on the basis of closing NAV minus opening NAV. Now we can calculate the return as under return is equal to closing NAV minus opening NAV plus dividend receipt plus capital gain receipt, entire thing divided by opening NAV, and entire thing should be multiplied by 100. Now I am going to discuss different plans under mutual fund. Now under this, number one is dividend payout plan. Under this plan, mutual fund company declares and distribute dividends to its unit holders on regular basis. Now, what is the impact of this? NAV will fall and number of units will remain same. Number two, bonus plan. Free units are distributed to the unit holders like bonus shares. And what is the impact of the same on NAV? NAV will fall and number of units will increase. In third category, we are having growth plan. Neither dividend is distributed, nor are bonus units are given. NAV will increase to the extent of growth. Now, what is the impact on NAV? NAV will change according to the market only, and number of units will remain same. Now, the last one is dividend reinvestment plan. Although dividend is declared but it is not paid, amount of dividend is again reinvested at the ex-dividend NAV price prevailing at the time of declaration. Now, what is its impact on NAV? NAV will fall and number of units will increase. Now, I am going to discuss expense ratio. Expense ratio is equal to expenses incurred per unit divided by average net asset value, where average net asset value is equal to opening net asset value plus closing net asset value whole thing divided by 2. Now I am going to discuss the relationship between return of mutual fund, recurring expenses, issue expenses, and return desired by investors, that is indifference point. Required return by investors is equal to return of mutual fund minus recurring expenses, and that should be multiplied by 1 minus issue expenses. Now, now I'm just going to use two words, that is entry load and exit load. Entry load is paid by the investor at the time of purchase of mutual fund unit. Sale price of NAV is equal to net asset value multiplied by 1 plus entry load. Now I'm going to discuss about exit load. Exit load is paid by the investor at the time of selling of mutual fund units, where a realized value of NAV is equal to NAV multiplied by 1 minus exit load. Now, when the mutual fund consistently underperforms the broad-based index, it is high time that we should get out of the scheme. It would be better to invest in the index itself, either by investing in the constituents of the index or by buying into an index fund. When the mutual fund consistently underperform its peer group instead of it being at the top, in such a case, it would be better to get out of the scheme and invest in the winning schemes. When the mutual fund changes its objectives, that is, instead of providing a regular income to the investor, the composition of the portfolio has changed to a growth fund mode, which is not in tune with the investor's risk preferences. When the investor changes his objectives of investing in a mutual fund, which no longer is beneficial to him, when the fund manager handling the mutual fund scheme has been replaced by a new entrant whose image is not known. So the points that I have mentioned here rightly, these are the signals highlighting the exit of the investor from the mutual fund scheme. Now, we may discuss now limitations and drawbacks of investing in mutual fund. There is no guarantee of return as some mutual funds may underperform and mutual fund investment may depreciate in value, which may even affect erosion or depletion of principal amount. Diversification may minimize risk but does not guarantee higher return. Mutual funds performance is judged on the basis of past performance record of various companies, but this cannot take care of or guarantee future performance. Mutual fund cost is involved, like entry load, exit load, fees paid to asset management company, etc. There may be unethical practices. Just for an example, diversion of mutual fund amounts by mutual fund or funds to their sister concerns for making gains for them. Mutual fund systems do not maintain the kind of transparency they should maintain. Next, many mutual fund schemes are at times subject to lock-in period, hence deny the market-drawn benefits. At times, the investments are subject to different kind of hidden costs. And the last one, redressal of grievances, if any, is not easy. Now I am going to discuss about exchange traded funds and what are its key features. Exchange traded funds, known as ETF, were introduced in US in 1993 and came to India around 2002. ETF is a hybrid product that combines the features of an index mutual fund and stock, and hence, is also called index shares. These funds are listed on the stock exchanges and their prices are linked to the underlying index. The authorized participants act as market makers for ETFs. ETF can be bought and sold like any other stock on stock exchange. In other words, they can be bought or sold anytime during the market hours at prices that are expected to be closer to the NAV at the end of the day. NAV of an ETF is the value of the underlying component of the benchmark index held by the ETF plus all accrued dividends less accrued management fees. There is no paperwork involved for investing in an ETF. This can be bought like any other stock by just placing an order with a broker. Some other important advantages of ETF are as under. Number one, it gives an investor the benefit of investing in a commodity without physically purchasing the commodity like gold, silver, etc. It is launched by an asset management company or other entity. The investor does not need to physically store the commodity or bear the costs of upkeep, which is part of the administrative cost of the fund. An ETF combines the valuation feature of a mutual fund or unit investment trust, which can be bought or sold at the end of each trading day for its net asset value, with the tradability feature of a closed-ended fund which trades throughout the trading day at prices that may be more or less than its net asset value. Now, some other points that I am going to discuss. So here it is distinction between open-ended and closed-ended schemes. Open-ended schemes do not have maturity period. These schemes are available for subscription and repurchase on a continuous basis. Investor can conveniently buy and sell unit. The price is calculated and declared on daily basis. The calculated price is termed as NAV. The buying price and selling price is calculated with certain adjustment to NAV. The key feature of the scheme is liquidity. I am coming to the last, that is closed-ended scheme has a stipulated maturity period, normally 5 to 10 years. The scheme is open for subscription only during the specified period at the time of launch of the scheme. Investor can invest at the time of initial issue and thereafter they can buy or sell from stock exchange where the scheme is listed. To provide an exit route, some closed-ended schemes given an option of selling back repurchase on the basis of NAV. The NAV is generally declared on weekly basis. So that is all about. And one thing we should remember always, happiness always looks small if you hold in your hands, but learn to share it, you will realize how big and precious it is. That is all about so far this video is concerned. Hope you are well, staying safe, healthy, and staying at home. Thank you. Goodbye.